Understanding Investment Risk for Beginners. Hey everyone, welcome back to Finance Clarity. Let me ask you something that might feel a little uncomfortable. When you hear the word investing, what's the first thing that comes to mind? For many people, it's not growth or opportunity, it's risk. The fear of losing money. And honestly, that fear is understandable. You've probably heard stories about people who lost everything in the stock market, or you've seen the market crash and recover multiple times. It's natural to feel cautious. But here's the problem. Most beginners either avoid investing altogether because of risk, or they invest without truly understanding what risk means. Both approaches can be costly in the long run. The truth is, all investing involves some level of risk. There's no such thing as a completely risk-free investment that also offers good returns. The key is not to avoid risk entirely, but to understand it, measure it, and manage it properly. In this video, I'm going to break down understanding investment risk for beginners in a clear and practical way. I'll explain the different types of risk, how to think about risk versus reward, and how you can invest more confidently without being reckless. If you want to invest but feel held back by fear of losing money, stick around. This video will help you see risk in a more balanced and realistic way. Let's get into it. What is investment risk, really? At its core, investment risk refers to the possibility that you could lose some or all of the money you invest. When you put your money into stocks, bonds, real estate, or other assets, there's always a chance that the value of those investments could go down instead of up. However, risk is not just about losing money. It also includes the uncertainty of returns. Even if you don't lose your original investment, your money might not grow as much as you expected, or it might grow at a very uneven pace. In simple terms, risk is the chance that your investment outcomes will be different from what you hoped for, and not always in a good way. Understanding this is the first step toward becoming a smarter investor. Why understanding risk matters for beginners. Many beginners either avoid investing completely because they're scared of risk, or jump into investing without understanding the risks involved. Both approaches can hurt your long-term financial progress. If you avoid investing altogether, you might protect your money from short-term losses, but you also expose yourself to another kind of risk, the risk of not growing your money enough to achieve your financial goals, like retirement. On the other hand, if you invest without understanding risk, you might take on too much risk without realizing it, which can lead to panic selling during market downturns or making poor decisions. This is why learning about investment risk is so important, especially when you're just starting out. Different types of investment risk. Investment risk comes in many forms. Here are some of the most common types beginners should understand. 1. Market risk, systematic risk. This is the risk that the overall market or economy will decline, affecting almost all investments. Events like recessions, interest rate changes, or global crises can cause widespread drops in stock prices. 2. Company-specific risk, unsystematic risk. This is the risk related to an individual company. Factors like poor management, product failures, lawsuits, or industry problems can cause a specific stock to perform badly, even if the overall market is doing well. 3. Inflation risk. This is the risk that your investments won't grow fast enough to keep up with rising prices. If your returns are lower than the inflation rate, your purchasing power decreases over time. 4. Interest rate risk. This mainly affects bonds and other fixed income investments. When interest rates rise, the value of existing bonds usually falls. 5. Liquidity risk. This is the risk that you won't be able to sell your investment quickly when you need the money, or that you'll have to sell at a lower price than you'd like. 6. Currency risk. If you invest in assets outside your home country, changes in exchange rates can affect the value of your investments. 7. Longevity risk. This is the risk of outliving your savings, especially important when planning for retirement. Understanding these different types of risk helps you make more informed decisions about where and how to invest. Risk versus reward. The fundamental trade-off. One of the most important concepts in investing is the relationship between risk and reward. Generally speaking, higher potential returns usually come with higher risk. Lower risk investments typically offer lower potential returns. For example, savings accounts and government bonds are considered low risk, but they usually offer very low returns. Stocks, especially individual stocks or growth stocks, have higher potential returns, but also much higher risk of losing value. This doesn't mean you should always take the highest risk for the highest reward. Instead, the goal is to find the right balance based on your financial goals, time horizon, and personal comfort with risk. Understanding this trade-off helps you avoid two common mistakes: taking too much risk and panicking when the market drops. Taking too little risk and not growing your money enough to reach your goals. How to measure and think about investment risk. While you don't need to become an expert in financial mathematics, it's helpful to understand some basic ways risk is measured. 1. Volatility. This refers to how much an investment's price moves up and down. High volatility means bigger swings in value, both up and down. Low volatility means more stable prices. 2. Standard deviation. This is a statistical measure of volatility. Higher standard deviation equals higher risk. 3. Beta. This measures how much a stock or fund moves compared to the overall market. A beta above 1 means it's more volatile than the market. A beta below 1 means it's less volatile. 4. Maximum drawdown. This shows the largest peak-to-trough decline in an investment's value. It helps you understand how bad things can get during a bad period. As a beginner, you don't need to calculate these numbers yourself. Most investment platforms and research tools will show you risk metrics. The key is to understand what they mean and how they relate to your comfort level. How to manage investment risk as a beginner. Here are some practical ways to manage risk when you're just starting out. 1. Diversify your investments. Don't put all your money into one stock, one sector, or one type of asset. Spreading your money across different investments reduces the impact if one of them performs poorly. 2. Invest for the long term. The longer your investment time horizon, the more time you have to recover from short-term market declines. This is why time in the market is often more important than timing the market. 3. Understand your risk tolerance. Be honest with yourself about how much volatility you can handle emotionally. If big market drops would cause you to panic and sell, you might need a more conservative portfolio. 4. Use dollar cost averaging. Instead of investing a large amount all at once, invest smaller amounts regularly over time. This can help reduce the impact of market volatility. 5. Rebalance periodically. Over time, some investments in your portfolio may grow faster than others, changing your overall risk level. Rebalancing helps keep your portfolio aligned with your original goals. 6. Keep learning. The more you understand about investing and risk, the better decisions you'll make. Education is one of the best risk management tools available. Common mistakes beginners make with investment risks. Here are some mistakes you should try to avoid. Taking on too much risk too early because they want high returns. Avoiding all risk and keeping money in cash or low-return investments. Panic selling during market downturns. Not diversifying properly. Putting too much money into one stock or sector. Ignoring fees and how they affect long-term returns. Making emotional decisions instead of following a plan. Understanding risk helps you avoid these common pitfalls and invest more thoughtfully. Final thoughts. Investment risk is not something to be feared or ignored. It's something to be understood and managed. Every investment carries some level of risk, but not all risks are the same. By learning about the different types of risk, understanding the relationship between risk and reward, and applying smart risk management strategies, you can invest more confidently and effectively. Remember, the goal is not to eliminate risk completely. The goal is to take on the right amount of risk for your goals and situation, and to manage it wisely over time. If you're just starting out, focus on building good habits, diversify, invest for the long term, understand your own risk tolerance, and keep learning. These foundations will serve you well as your investment journey progresses. Thanks for watching. If this video helped you understand investment risk better, please like and subscribe for more beginner-friendly investing content. Drop a comment below and let me know what questions you still have about investment risk. I read every comment. I'll see you in the next video. Take care.